Very good morning, my dear soldiers. Welcome to ICAI LCC Batch 7 classes. This is Satyarazu Kuluru. I am association with ICAI since past 7 batches. Here I am to deal total 3 topics of advanced accounting. So, which are number 1, amalgamation of the companies. Number 2, internal reconstruction. Number 3, liquidation of companies. So one more important fact just I want to discuss before start my session. Out of these 3 topics, amalgamation, internal reconstruction are form part of the new syllabus which is released by ICAI as well. So liquidation of companies chapter is there as per old syllabus. It will not be form part of the new syllabus. And one more thing. So yesterday night itself, I placed all the relevant materials related to these 3 chapters under material corner. Please have a look and download it and make it as a handy the PDF copies or the hard copies, whichever you want. And whenever I am dealing with any specific concept, so if you are facing any issue or if you want to just ask any query or any doubt, so please all of you use your question box chat. I'm freely available. I may not check for each and every second. It's very difficult and the flow will be impacted. I will check randomly. So collectively, I will provide the answers in between the sessions or at the end of the session as per my feasibility. Is it okay, guys? Are you with me? Can you put all of you thumbnails or something to proceed with? You are in line with me? Anyone, at least if I can check one thing in the question box, I'm pretty much confident to go ahead. I know there is some delay in between the message and here. Yes, now I can able to see here. That's fine, guys. Sir, which materials you provided in the material corner, sir? Can you please just give clarification here itself? Totally, I provided 2 documents. So one is the main material. One is the main material, which consists concept, that is the total theoretical contents, as well as problems. So all the problems are completely designed from ICAI material, but just I arranged such problems in logical manner. That's it. And the solution material I provided separately for your convenience. Okay. So which was placed separately. What are the problems included under the main material? So just I was given through a solution material. So apart from these, at the end of the sessions, I'll provide one more material related to these 3 chapters only. That is pure written PDF copy. Okay. It will be something look like this. So intentionally, I'm not providing right now. You may get it at the end of the sessions. This is the written material. So entirely done by me. So it is highly useful at the time of revision or at the time of recollecting the things before going for the examination. With that intention, I'll provide this one as well. Okay, no worries. So related to these particular 3 chapters, what are all the inputs required? So definitely I'll give. So just your parties, just in line with me, give proper attention. So before listening the sessions. And all the three topics are big topics. So already you might have, if you already listened so previously, or if you are a fresh student, it doesn't matter for me. So all the three chapters are big chapters. That's why it required some patience to understand the content or the concept. But once if you feel comfortable, you can able to handle any problem. Fine. Now let me start with my session. And one more thing, I forgot, which is the last thing I want to provide as input before starting with the sessions. Sir, what is the plan about these three particular sessions? Total for these three particular sessions, we are going to deal under 9 slots total. So out of the 9 slots, dedicatedly around 4 to 4.5 slots. Okay. For amalgamation chapter, 4 to 4.5. I can't put it as exact figure. Internal reconstruction is like around, it will take 2.5 sessions. Okay. And the liquidation of companies will be around 2.5 sessions. So more or less, it will be completed total in the 9 slots. This is the plan what I have. So you may also have the faculty or the classes plan. So please all of you follow accordingly. So any doubts till now before starting? Can I start? Can I go ahead? Sir, material is not yet available. It takes some time for the material to update in the BOS. Okay, maybe. I don't know. That's the reason I uploaded yesterday itself. Okay, it is still not visible. No worries. Everything I'll show it under screen. So once the class got completed, just you can ask the concerned person and he will definitely place it. I thought of it was already placed. So just have a look. If it is not it, no worries. Fine, guys. Let me start the journey. Guys, do you ever listened or seen the word reconstruction? I'm not asking anything about our accounting or the financial reporting, nothing. As a general common word, just I'm asking. Do you ever seen the word reconstruction? In a layman approach, what is the meaning of reconstruction? It's simply, generally, the construction is related to, so construction of structures or buildings or something else. So that's why reconstruction is nothing but rebuilding something, right? Whatever the case may be. In common parlance, I'm talking. Sir, the rebuilding concept or the rebuilding process may happen in two ways. Or first of all, if I want to speak something related to the construction, why we should need to reconstruct? There are some problems we are facing with the existing constructions or existing structures. That's why we want to go for the reconstruction or the rebuilding. Such type of rebuilding may happen in two ways. May happen in two ways means you can demolish the existing building completely. Demolish the existing building and go for the new construction altogether. This is the one option is available. Another option is also available. Rather than going for the demolition, it is better to go for renovation if it is possible. Sir, both are having their own advantages and disadvantages. If I go for the first option, what are the advantages or the disadvantages here, sir? The advantage is altogether the new building is look like a brand new building. So no one can remember the old building structure. So altogether the old building was demolished. It is a new building. But the disadvantage is it is huge cost. Do you agree? Huge expenses or cost we may incur. Sir, in case of renovation, the advantage is, what are the disadvantages is there under option number 1, which is advantage. That means, which is less expensive or which is cost effective. What is the disadvantage, guys? Even though if you are making certain renovations, people can simply recognize that still it is a old building only. So just they made certain renovation activities, maybe certain interior designs or something, some decoration activities, or maybe if the building is not in a proper manner, then they may go for fulfill of holes or something like that. But still people can easily find that which is an old building. That's where the brand loyalty is very less. Guys, this is accounting class only. Okay, no worries. I'm dealing with the concept of accounting only, but this is the base for understanding all the relevant topics. Just provide some time to me. I will connect every dot. You can understand pretty much easily. Now, if this is the situation, if we are facing with the existing building, then we are having two options, that demolishing and new construction, or without demolishing, either we can go for renovation, right? Similarly, my question is, if a corporate is facing some problems, or if a corporate financial statements are not showing in true and fair view due to some problems faced by them, then how they can go for reconstruction? Or first of all, what is the necessity or what is the reason for doing such reconstruction process? I will give a small example to understand which type of problems in generally a corporate will face. Let me consider a company which is suffering from huge losses since past few years, which is a company who is suffering losses since past few years. Let me consider that company information from my PDF. Guys, sometimes to save my time, I'm jumping from here to there. Whatever the content I want to write, I'll put it under my OneNote. So if it will take much time, I'm trying to explain directly from the PDF. That is the reason why I'm using the PDF as well. So this is the company. I hope you can able to see my screen. This is the balance sheet of Rani Limited as at 31st March 2020. So the Rani Limited is suffering losses since past few years. Let us assume something like that. So its balance sheet is look like this. Share capital, that is equity share capital, is at 10 lakhs, 1 lakh equity share at the rate of 10 rupees each. Preference share capital, 5 lakhs, 10,000 preference shares at the rate of 50 rupees each. So the company also issued debentures. The company also have the bank loan for their respective amounts. So remaining 2.5 lakh is current liabilities. We are coming to asset side. PPE is at 10 lakhs, which is fixed asset or non-current asset. Intangible asset is at 4 lakhs. Current assets is given at 5 lakhs. Profit and loss account, if you check debit balance. So debit balance means loss. Guys, this is not the balance sheet prepared as per schedule 3. So a typical simple balance sheet just I considered. So that's why just I simply shown the P&L account debit balance under asset side for the time being. And this is miscellaneous expenditure not written off, which is at 2,50,000. Now, after seeing this balance sheet, we can simply conclude that Rani Limited is a loss-making company, and whatever the losses represented in the balance sheet are accumulated losses. So that's why, which is a sick company. Now, my conclusion is it the components of the financial statements? Is it their true figures? No. How you know, sir? I was clearly given that whatever the intangible assets which were given in the balance sheet, which were unrepresented intangible assets. Sir, what is the meaning of unrepresented intangible assets? Maybe goodwill is there only for the sake of books, but which is a loss-making company, there is no real goodwill. Maybe we have some patents, maybe we have some formulas which are useless, but still they are having certain book value, even though they are not having any real valuation in the outside market. That's why those were unrepresented intangible assets. And that too, if you check miscellaneous expenditure not written off, which is a fictitious asset. Fictitious asset means it doesn't have any valuation, but still right now it is form part of the balance sheet. Due to such all components, the financial statements of Rani Limited is not depicting the true picture. There is a overvaluation of assets, or there is a overvaluation of net worth. Net worth means assets reduction with liabilities, right? So either there is a overvaluation of assets or the overvaluation of net worth, due to which the Rani Limited financial statements not depicting true picture. How a building is facing with certain problems. Similarly, the Rani Limited is facing certain problems with their financial structure. It is not showing true and fair picture. In case of building, we went for reconstruction in two manners, and to repair the existing Rani Limited to depict their true picture, we are also having two options. Such options are popularly known as internal reconstruction and external reconstruction. So in case of companies who's facing huge losses since few years, their financial statements are not depicting true picture. At that time, we have two options to repair that particular company. One is external reconstruction and the other one is internal reconstruction. Guys, are you with me, all of you? Fine. Sir, in case of external reconstruction, what happens, sir? What happened in the above my example? Demolition of the existing building and new construction. That means in case of external reconstruction, existing company is going to be liquidated. Existing company going to be liquidated. A new company is incorporated to take over the existing company. Simply in case of external reconstruction, altogether a brand new company is going to be incorporated in the place of the existing company. In case of internal reconstruction, what happens, sir? In case of internal reconstruction, the existing company will not liquidate. Existing company is going to continue their operations. So if you check, in case of renovation, what happened? We are not demolishing the existing building, just we are making certain renovation activities for the existing building. Similarly, in case of internal reconstruction, we are making certain internal adjustments without liquidating the existing company. So the prima facie difference in between external reconstruction and internal reconstruction is, in case of external reconstruction, definitely the existing company is going to be incorporated and the existing company is going to be liquidated. In that place, a new company is going to be incorporated. In case of internal reconstruction, the existing company is going to continue their operations by making certain internal adjustment. But the overall objective is showing the financial statements a true and fair picture. So with this background, so let me give some more information for external reconstruction and internal reconstruction with the help of my PDF. Sir, external reconstruction is going to happen as per section 232 of the Companies Act 2013. Internal reconstruction related provisions are dealing by section 61 and 66 of the Companies Act 2013. In case of external reconstruction, a new company, so-called as Raju Limited, is incorporated to take over the Rani Limited. So that's why new incorporation and existing liquidation is going to occur in case of external reconstruction. In case of internal reconstruction, without liquidation of the existing company, internal reconstruction process is going to happen. Now, if I want to talk about intricacies or the exact provisions or the exact process, what it is going to happen in that external reconstruction, internal reconstruction, it takes some more time. But as a beginning stage, to understand these terminologies in better manner, let me throw some more light. So these are a little bit technical. Please just try to understand as a basic level. Okay, so once the time progress, you can understand everything. No worries. Now, if I talk about external reconstruction, so let me first talk about external reconstruction. As I told you, in case of external reconstruction, what happened? A company which is Rani Limited is right now taken over by Razu Limited. So Rani Limited is an existing company which is taken over by Razu Limited, which is altogether a new company. You can also call in this manner, Razu Limited is a new company which is incorporated to take over the Rani Limited. That's why Razu Limited, you can call it as a purchasing company. Do you agree? Razu Limited is a purchasing company. Rani Limited is a selling company. Razu Limited is a transferee company or the transferor company. So this is transferor, this is transferee. So the company who is transferring their business to the other company is known as transferor, and the other company is known as transferee company. Okay. So like that, you can give various terminologies to the existing companies. Now, what is our objective in this chapter, sir, actually? Now, the external reconstruction is entirely we are going to discuss through the chapter amalgamation. The internal reconstruction we are going to discuss through the chapter internal reconstruction. Liquidation of companies is a chapter which we are not dealing with any accounting issues. We are dealing with provisions of Companies Act 2013. What are the procedures we should need to adopt at the time of liquidation of the company? The statutory provisions we should need to adopt, or what are the various statements prepared by the respective parties we are going to discuss. Literally, we are not going to discuss any accounting issues in this specific chapter. That's why this chapter is altogether different. So whatever the introduction or the discussion I'm going to make till now, those are relevant for amalgamation and internal reconstruction. So separately, let's discuss about the liquidation of companies introduction. Now, sir, what is the relation between external reconstruction and amalgamation? Our topic name is amalgamation, but still you are discussing about external reconstruction only. Now, let me introduce the word amalgamation or the concept of amalgamation, how it is relevant for external reconstruction. You can simply understand. Amalgamation. So in case of amalgamation, what happened? A new company is incorporated to take over two or more existing companies. For example, one company is A Limited and another company is B Limited. These two are two different companies and both are existing companies. Let us assume a new company AB Limited is incorporated. So AB Limited is altogether a new company. A Limited is an existing company. B Limited is also an existing company. Now, a new company is incorporated to take over two or more companies, two or more existing companies. Then such process is technically known as amalgamation. Sir, another word also you may commonly listen or you may commonly see throughout the chapter, that is absorption. Once again, don't confuse with any terminology here. First, let me introduce one by one word. Then I'll discuss the difference between the difference among the each terminology as well. In case of absorption, what happened? An existing company, let us assume D Limited is here, E Limited is here. So D Limited is altogether an existing company. E Limited is also an existing company. Now, an existing company wants to take over another existing company. Then such process is known as absorption. Simply absorption is nothing but blending of one company into the other company. One company absorbs another company. When it is possible, when both the companies are existing company. There is no new incorporation in case of absorption, actually. So the purchasing company is also an existing company. This process is known as absorption. Sir, you introduced or you are dealing total 3 terminologies. One is external reconstruction, one is amalgamation, and the other one is absorption. Can you please explain the difference between these 3 concepts first? In case of external reconstruction, a new company is incorporated to take over an existing company with an objective that to show the financial statements of the existing company at true and fair picture. Or the existing company, if at all, if it is facing certain problems, then we are adopting the process of external reconstruction to convert their financial statements into true and fair view. Do you agree? But the objective in case of amalgamation or absorption is quite different. The objective of amalgamation or absorption is not to show the financial statements at true and fair view. The financial statements are absolutely prepared by showing the true and fairness. But the reason may be the adoption of amalgamation is to avoid the competition. To avoid the competition. Maybe you might have heard the recent banking companies amalgamation. Not that much of recent, like it already completed like 2 to 3 years. For example, I can give this example. Andhra Bank is a famous bank which was merged into Union Bank. So like that, some of the banks just they merge into the other banks. You might have had such type of amalgamation process. This is to avoid the competition, or maybe to get the synergy benefits. So what is the meaning of synergy benefits, sir? Synergy benefit means 1 plus 1 is greater than 2. If we combine each other, it will be more than our real energy to get such synergy benefits. Or maybe to get the taxation benefits. How the taxation benefits? They are going to derive either through process of amalgamation or absorption, sir. Let us assume A Limited is a loss-making company. B Limited is another loss-making company. I will explain through absorption. You can understand in a better manner this taxation benefit concept. So D Limited is a loss-making company. E Limited is a profit-making company. Sir, why a profit-making company wants to take over a loss-making company, sir? Whatever the losses suffered by the existing companies are nullified by the profits. So you may learn the concept related to the income tax provisions in your group 1 syllabus. In case of amalgamation, there are certain provisions we can able to set off the losses which were derived by the previous company, right? So this benefit will be there. And not only that, if the existing company is a loss-making company, then E Limited here bargain the price like anything. To acquire the D Limited, it may pay very less price while compared with the market price. Do you understand? Such type of advantages or such type of privileges it may have. So that's why I cannot tell this is the reason why we are going for amalgamation. In their back of their minds, they may have different objectives. But definitely in case of amalgamation or absorption, their objective is not to depict true and fair picture as like in case of external reconstruction. The objective is quite different. Sir, then why you are dealing these three topics simultaneously? Sir, there is a clear-cut difference between external reconstruction and amalgamation and absorption. But why still you are dealing these three topics in the chapter amalgamation? Please concentrate, all of you. Whether it is external reconstruction or amalgamation or absorption, I am only having two set of companies. One is selling company and the other one is purchasing company. Here if you check, Rani Limited is a selling company, Raju Limited is a purchasing company. Here if you check, A and B Limiteds are selling companies, AB Limited is a purchasing company. In case of absorption also, if you check, here D Limited is a selling company, E Limited is a purchasing company. So that's why even though the objectives are different, for the purpose of providing accounting treatment, I can classify these companies into two types. One is selling company and the other one is purchasing company. The accounting treatment we are going to provide in the books of selling company as well as in the books of purchasing company is uniform throughout all the three different concepts. Whether it is external reconstruction or amalgamation or absorption, if they want to ask to provide accounting treatment in the books of selling company, which is constant, which is equal or which is same for throughout all the three concepts. In case of purchasing companies also, the same process. Is it okay? Do you agree? So I told the difference between external reconstruction, amalgamation and absorption, and why we are dealing combinedly also, I told you. And one more thing, it is clearly given in the notes itself. Whenever they are talking about the concept of amalgamation, it includes absorption as well. Whenever I'm talking about the concept of amalgamation, it includes absorption as well. That means whatever the provisions or whatever the accounting treatment we are going to adopt in case of amalgamation, the same concept is equally applicable in case of absorption as well. And one more thing, one type of amalgamation are in generally people calling it as external reconstruction. So again, it is a little bit confusing, sir. A classic example for external reconstruction is one type of amalgamation. That is amalgamation in the nature of merger actually. This is too early to discuss. Just I'm telling you at this moment, only just to remember that. I will connect at later point of time when I'm discussing about the types of amalgamation. Okay. Amalgamation in the nature of merger. Amalgamation in the nature of merger is a classic example for external reconstruction. That is the reason why in the chapter amalgamation, we are going to discuss something related to amalgamation. We are going to discuss something related to absorption as well as external reconstruction. That's why this topic is pretty much broader, not only covering the pure amalgamation, we are also trying to covering the other issues like absorption and external reconstruction. But for problem solving or at the time of providing accounting treatment, there are no confusions at all, because in all the three different concepts, we are going to see only two different entities. One is selling company and the other one is purchasing company. I only check whether I'm going to provide accounting treatment in the books of selling company or accounting treatment in the books of purchasing company. Remaining all doesn't matter for me. Is it okay, guys? All of you with me? Let me check at this stage if you are having any queries. Anyone having any issues? Shall I continue? So please confirm, guys. So because this is my first session, just I want to know whether my flow is it okay, or should I need to make it a little bit speedier, a little bit slower, or at this moment, at this flow. Just let me know, guys. It's fine, right? Okay, that's great. Superb. Now let me go back to my PDF here, guys. 1 second. So the same examples what was I discussed, I given here. Amalgamation, We told new companies incorporated to take over two or more existing companies. So maybe the reason is to get the taxation benefits, to avoid the competition, to get the synergy benefits, maybe as a process of expansion, maybe economies of scale, maybe due to any reason. In case of absorption, an existing company is take over another existing company. So this is called absorption. And external reconstruction already. And the objective of amalgamation to absorption and external reconstruction is altogether different. But accounting treatment wise, we are following the same accounting treatment. Now, let me discuss the concept of amalgamation as well as various types of amalgamation. So the concept of amalgamation right now you may avoid somewhat. So, but whenever I'm talking about the amalgamation, please include the word absorption as well. I'm not adding I'm not adding every time the word absorption. So it includes automatically absorption as well. So what are the various types exist in case of amalgamation, or what are the popular types of amalgamation? Sir, in the market, actually, various types of amalgamations are exist. We are dealing the types of amalgamation for the purpose of providing accounting treatment. Okay. Sir, if you check in the internet or in the realistic amalgamations, the types may be different. It may people may call off spin-off. Okay. People may call off merger, or people may call off buyback, something like that. They may use the different words. I'm not talking about that. I'm talking about types of amalgamation for the purpose of providing the accounting treatment. So for the purpose of providing accounting treatment, amalgamation is basically divided into two types. So one is amalgamation in the nature of merger. I already revealed earlier itself. Amalgamation in the nature of merger. And another one is amalgamation in the nature of purchase. So one is amalgamation in the nature of merger, and the other one is amalgamation in the nature of purchase. For which purpose, guys? For the purpose of providing accounting treatment. Sir, when an amalgamation is said to be amalgamation in the nature of merger, sir? When an amalgamation is said to be amalgamation in the nature of purchase, sir? If all the below 5 conditions satisfied, if all the below 5 conditions, then the amalgamation is said to be amalgamation in the nature of merger. If any condition not satisfied, then the amalgamation is said to be amalgamation in the nature of purchase. Guys, don't give concentration on writing the things on your notepad. Okay, so everything I'll provide. So just you can listen the session in peaceful manner. That is more than enough. So don't waste your time on recording something. Okay, if any new thing is there, definitely I'll tell you, which is not covered in my material or in my PDF, then I'll tell you at that moment you can record that, because I know it's very too difficult task to seeing the screen, to writing something under the notepad. So that's why don't make it ready your notes. So I already done everything. So your life will be very easy. So just you can have that particular material, you can read it. That is more than enough. Okay. So fine. Just give a moment, guys. 1 second, please. Right. Sir, if all the conditions satisfied, then you said that the amalgamation is amalgamation in the nature of merger. What are such conditions, sir? Total, we have 5 conditions. Let me explain one by one condition. Condition number 1. Sir, let me take the example of absorption. Here itself, it is there, delimited and delimited. Okay. Sir, D Limited is a selling company, you know, E Limited is a purchasing company. Now, the first and foremost condition is to put it the amalgamation as amalgamation in the nature of merger. Purchasing company should need to take over all the assets and liabilities of the selling company. Sir, in case of absorption or amalgamation or external reconstruction, what is going to happen? Purchasing company is going to purchase the business of the selling company. Sir, business of the selling company means assets and liabilities only, right? Selling any company or any entity is having in their balance sheets only assets and liabilities. So that's why here, if purchasing company is ready to take over all the assets and liabilities of the selling company, then only we can call it as amalgamation in the nature of merger. So that means if purchasing company is ready to take over only part of the assets, then we can call it as amalgamation in the nature of merger, sir. No, straight away it will go to amalgamation in the nature of purchase. The first condition itself is dissatisfied. That's why the first and foremost condition is all the assets and liabilities of selling company should be taken over by the purchasing company. Second condition, all the assets and liabilities should be taken over at book values only. What is the meaning of this, sir? For example, here D Limited is having, let us assume, building, it have 1 crore worth. Now E Limited is also valuing the same building for 1 crore, irrespective of the market value. What are the assets or liabilities exist in the selling company with the same existing book values? If the purchasing company is ready to take over, then such amalgamation, we can call it as amalgamation in the nature of merger. Again, if the purchasing company, even though take over all the assets and liabilities, but it doesn't take over at the book value, sir, it will assign different value based upon their market interpretation, then which is pure amalgamation in the nature of purchase. Okay, hope you understand these two conditions till now. Third condition. Guys, once the purchasing company is take over the selling company, if we are purchasing something, we should need to pay some amount to the other entity, right? That means purchasing company should definitely need to satisfy something to the selling company, right? Which is popularly called as purchase consideration. So I'm calling it as PC. Always, to put it as a shortcut, I will call it as PC. So as a purchase of something, if you purchase any product, you will pay something to the other party definitely, which is nothing but purchase cost, or which is nothing but purchase consideration in the other entity point of view. In selling company point of view, which is the sale price. In purchasing company point of view, which is purchase price. So that's why in between the two entities, I can call it as purchase consideration. Now, the purchase consideration issued or paid by the purchasing company should be in the form of fully paid up equity shares only. So that means, is it cash is not allowed? Yes. Sir, is it preference shares is not allowed? Yes. Sir, debentures is not allowed? Yes. Any other form of assets also not allowed? Yes. If in your PC, if any other form other than equity shares are included, then automatically the amalgamation will be treated as amalgamation in the nature of purchase. So that's why the third condition in case of merger is PC should be in the form of fully paid up equity shares only. That to not partly paid up. If you check, fully paid up equity shares only. Is it okay, guys? Next, let me explain the fourth condition here. After amalgamation, at least 90% of the share capital held by the certain shareholders in the selling company should need to become the shareholders of the purchasing company. Sir, we can't understand, sir. For example, D Limited is here. Let us assume D Limited share capital is there. Sir, D Limited share capital 1 crore is there. Out of this 1 crore, that is 90 lakh share capital is held by some shareholder. They should need to become the shareholders of the purchasing company. How it happens, sir? Sir, E Limited, that is purchasing company, in the form of PC, it is issuing equity shares only. That means whatever the PC issued by the purchasing company should need to be distributable among the shareholders of the D Limited. Then automatically not less than 90% share capital held in the selling company automatically become the shareholders of the purchasing company. So why they levied such condition? Whatever the PC received by the selling company, it should need to be distributable among the shareholders. It should not be given to any other liability holders. If that is the case, then the amalgamation, we can call it as amalgamation in the nature of merger. So simply I'll write in this way, not less than, or shareholders holding not less than 90% share capital in selling company should become the shareholders of purchasing company by virtue of this amalgamation. So due to this amalgamation, shareholders holding not less than 90% share capital in the selling company automatically become the shareholders of purchasing company. If that is the case, then the amalgamation is said to be amalgamation in the nature of merger. And the last condition, guys, which is the fifth condition, purchasing company should need to continue the same line of business, after takeover. The same line of business means, for example, if the purchasing company is into telecom industry, then after takeover of the selling company, the purchasing company should need to continue the same business. So that's the reason why in generally this process of amalgamation is going to occur into two similar industries. So dissimilar industries in generally not go for amalgamation. So that is not the criteria. If they are not into the similar industries, then automatically the amalgamation will become amalgamation in the nature of purchase. So I'm not putting a condition that amalgamation should always need to happen between the two similar industries. In general, I'm talking the amalgamation is going to occur in between two similar industries or in two similar business. But if those are dissimilar businesses, still which is form part of amalgamation only, but which is not covered under amalgamation in the nature of merger, which is covered under amalgamation in the nature of purchase. So if all the 5 conditions satisfied, then which is amalgamation in the nature of merger. If any one condition not satisfied, then automatically it will become amalgamation in the nature of purchase. Sir, why we learned all these things? To provide accounting treatment in their books. Now, let me add one more point here to understand in better manner why we are learning all these types of amalgamation and the differences for all such things. Okay. What are that? So totally in this chapter, we are trying to provide, or we are trying to discuss 3 different concepts. Okay. One is accounting treatment in the books of selling company. Another one is accounting treatment in the books of, or let me write here, accounting treatment in the books of what is the other type of the company? Purchasing company. And one more word I told you, ultimately the purchasing company should need to pay certain amount either in the form of equity shares or preference shares or debentures or cash or in any other asset, which is popularly called it as PC, purchase consideration. So totally we are going to deal these three concepts only. One is accounting treatment in the books of selling company, and the other one is accounting treatment in the books of purchasing company, and the other one is purchase consideration. Now, sir, types of amalgamation concept we learned na. This concept is relevant in which concept, sir? I mean, is it in the books of selling company, or for the purpose of calculation of PC, or for the purpose of providing accounting treatment in the books of purchasing company? Type of amalgamation is irrelevant in the books of selling company. That means whether it is amalgamation in the nature of purchase or amalgamation in the nature of merger, accounting treatment in the books of selling company is constant or is the same. For the purpose of calculation of PC also, type of amalgamation doesn't matter. Only to decide accounting treatment in the books of purchasing company, to decide accounting treatment in the books of purchasing company only, we should need to check type of amalgamation. Sir, if the type of amalgamation is amalgamation in the nature of merger, amalgamation in the nature of merger, then the method of accounting we should need to adopt in the books of purchasing company is pooling of interest method. Let me give different color. Pooling of interest method. I'm not explaining anything, guys. Just I'm introducing the words. Sir, if the amalgamation is amalgamation in the nature of purchase, if the amalgamation is amalgamation in the nature of purchase, then method of accounting need to be adopted is purchase method. To know pooling of interest method is applicable or purchase method is applicable, first we should need to decide type of amalgamation. We can able to decide the type of amalgamation based on these 5 conditions. If all the 5 conditions satisfy, amalgamation in the nature of merger, otherwise amalgamation in the nature of purchase. That means to provide the accounting treatment in the books of purchasing company, only I should need to think all these points. But to provide the accounting treatment in the books of selling company or for the purpose of calculation of purchase consideration, no need to think about the type of amalgamation. Is it fine, guys, all of you? Can you please confirm all? Is it fine? Sir, absorption and acquisition are same. Guys, at this stage, just I want to tell you one thing. In the exams or in the problems, wherever, whatever the case may be, whatever the terminology they used, just to take it. Because for problematic wise, they are not differentiating amalgamation, absorption, external reconstruction. Even they may not specify clearly as well. Because their intention is want to provide accounting treatment either in the books of selling company or either in the books of purchasing company or calculation of PC. For doing these things, no need to require whether it is amalgamation or no need to know whether it is amalgamation, absorption, acquisition, whatever the case may be, external reconstruction. I need to only check whether it is selling company or purchasing company. Okay. Hope I gave the answer for your question. Darshan. Okay. So there are no other queries. Fine. Guys, let's do one thing at this stage. I can't like give the break in between because which are having much more links to explain any specific concept. Do one thing. You can just go for the break. So please all of you assemble by 8:10. So let's begin the second half by 8:10. So it's very interesting session and like which is the key area or heart of the entire amalgamation. If you can able to understand the second half, you can able to resolve any problem as well. This which is the base concept. Don't miss it. Let's assemble exactly by 8:10. Okay. Hi guys, welcome back. So before the break, just we've seen what are the various issues we are going to discuss in this specific chapter. That is accounting treatment in the books of selling company and a calculation of purchase consideration and accounting treatment in the books of purchasing company. And types of amalgamation concept is relevant in case of or in the books of purchasing company alone. Now, one more important thing just I want to discuss before entering into the specific topics. You know, uh, one of the accounting standard which is going to deal with the amalgamation, which is accounting standard 14, right? As 14, accounting for amalgamation. Now here my point is it as 14 applicable in the books of selling company? Please provide your answers. Guys, be attentive and quickly let me know. Is it as 14 applicable in the books of selling company? The answer is no. AS14 doesn't applicable in the books of selling company. AS14 is applicable for the purpose of calculation of PC. Absolutely, yes. So PC computation related provisions, how it should need to be calculated, was completely suggested or guided by AS14 itself. And whatever the types of amalgamation provisions we discussed. So if all the 5 conditions satisfied, then we are said to be the particular amalgamation is amalgamation in the nature of merger. Otherwise, the amalgamation is amalgamation in the nature of purchase. All such issues were again discussed in AS14 only. That means even though a title, AS14 title is given that accounting for amalgamation, the AS14 is not applicable for all the set of books. AS14 is only applicable in the books of purchasing company only. AS14 doesn't applicable in the books of selling company. And for the purpose of calculation of PC, definitely AS14 relevance is there. Then let me start my discussion with this particular point, that is purchase consideration. Okay, please concentrate guys, which is heart of the entire chapter, whether it is amalgamation in the nature of merger or purchase, whatever the problem it is, without computation of PC, you can't even step down or one step down into the problem. Okay. So what is the meaning of the PC? Purchase consideration. What is the meaning of purchase consideration? As per accounting standard 14, PC is nothing but amount payable by purchasing company to the shareholders of selling company. It's very easy to look like, okay, but you can understand the pain of calculation of PC while going forward. Purchase consideration is nothing but amount payable by purchasing company to the shareholders of the selling company. Sir, here shareholders of the selling company means, is it we consider equity shareholders or preference shareholders or both? Both you should need to consider. Shareholders means it include equity, it include preference shareholders, both the type of shareholders. Sir, amount means, is it in the form of cash only? Is it in the form of equity shares or preference shares or debentures or any other asset? Anything is possible. That means let me give the each and every form of PC here. 1 second. So one popular form is cash, or maybe in the form of equity shares, or maybe in the form of preference shares, maybe in the form of debentures, or in any other form also, in any other asset or any other form, just simply, which is residuary head, other assets are form. So amount payable by purchasing company to the shareholders of the selling company alone treated as purchase consideration. Now let me ask few questions quickly to understand this sentence in better manner. The question is, for example, A Limited is a purchasing company, is going to issue PC in the form of cash, in the form of equity shares, in the form of preference shares, in the form of debentures as well. Cash is issued to equity shareholders of selling company. Equity shares issued to also equity shareholders of selling company. Preference shares issued to preference shares of selling company. Debentures issued to debenture holders of selling company. Now let me know, out of these existing four components, cash, equity shares, preference shares, debentures, all the components can I include in the calculation of PC, or any component should I need to exclude? Give your answers through query box. Again, I'm repeating, to calculation of PC, should I need to include all these four components, or should I need to exclude any particular component? No, still I'm not getting any answer. Guys, please be all of you participative. This is not the one-way communication. You should need to actively participate. Is it network delay issue, or you not yet provided any answers? At least one person, if you confirm. Okay, last component is to be excluded, I think, sir. Okay. Guys, please all of you read the sentence once again. Amount payable by purchasing company to the shareholders of the selling company. Whatever the amount, whether it is cash or equity shares or preference shares or debentures or other assets or the cash, if it is payable to shareholders of the selling company, then it is form part of PC. That means what I should need to check, to whom we are paying is relevant, but what we are paying is irrelevant. What we are issuing is completely irrelevant, but to whom we are paying or who ultimately receive those is an important fact to decide the purchase consideration. Do you agree? Now here if you check, this cash is received by whom or paid to whom? Equity shareholders. Yes, it is payable to shareholders. That's why it is form part of PC. No doubt about it. Equity shares of purchasing company. Payable to whom? Is it to the shareholders of the selling company? Yes, sir. It is form part of PC. Preference shares of purchasing company is payable to whom? Is it shareholders of the selling company? Yes, sir. Preference shareholder is also a shareholder of the selling company. Yes. Debentures, whom you should need to pay? Debentures holders of the selling company. So debenture holders of the selling company, is it shareholder of the selling company? No. That's why it is not form part of PC. So that's why what my conclusion is, always you should need to check this. What is that? What we are paying. What we are paying is irrelevant. To whom we are paying is relevant. So if it is paying to shareholders of the selling company, then it is form part of PC. Otherwise, it should need to be included in calculation of PC. Is it clear to all of you first this point? Right? Guys, simply just you cannot tell that, sir, debentures you can exclude form part of PC, sir. No, not like that. If such debentures are issued to the shareholders of the selling company, again, we should need to consider. For example, here just now I changed, let us assume these debentures are issued to equity shareholders of the selling company. Then, whatever the debentures we issue, debentures are also form part of PC. Do you understand? So that means what you should need to check, to whom you are issuing, you should need always check. But what we are issuing, just it doesn't matter. Just ignore that. Just check to whom you are issuing. If it is issuing or if it is paying to shareholders of the selling company, it is form part of PC. Hope you understand my point. So why I am explaining once again and once again. So this point creates a lot of difference while resolving the problem. If you include such things, then your entire problem gone. If the PC computation itself is wrong, even though if you provided the correct accounting treatment, correct terminal, correct ledgers preparation and journal entries, balance sheet, even though if you work out, nothing will be awarded. Okay, because what they can feel now, if you're unable to calculate the PC itself, then you don't have any command on the concepts. Okay, fine. Next one. Let me continue the journey. Still, I am in the discussion of PC only. This is not at end. It will take some more time. Sir, now we understand the basic provision of PC, which is nothing but amount payable by purchasing company to the shareholders of the selling company. Now, is there any various methods are available to calculation of PC? So there are various methods exist in the society to ultimately know that PC. But here we are not discussing all the methods. That too, the amount of PC is broadly based on the terms and conditions levied in the agreement in between the two entities. Are the terms and conditions agreed among themselves? Because if you check, one particular type of amalgamation may not be similar to another type of amalgamation. So they may give various conditions, they may levy the various conditions, they may levy the various provisions based upon their negotiations, based upon their feasibility factors, based upon their marketability strength, maybe based upon their product viability, maybe based upon their market stability. So various factors will be impacted. So that's why what I can tell, no one amalgamation is similar to each other in the business. Always there are their own approaches for calculation or deriving this PC. But for our academics, we cannot calculate PC, or we cannot provide all such terms and conditions in a given problem or in a given scenario. So to decide that, there are 4 important PC methods we are going to discuss in our academics, and which are popular methods. So whatever the PC method or whatever the PC calculation, if you can go with the real-time scenario, it may be almost matchable with the existing methods what I'm going to discuss. That means in the practical scenario, those methods will be similar, more or less additions, deletions will be there, lot of terms and conditions might be changed. But the methods which I'm going to explain are completely or strictly applicable for our academics only. That's the point just I want to convey. So then what are the various or popular methods available for calculation of this PC, sir? Methods of PC. I'm discussing methods of PC. So number 1, net payments method. Net payments method. Number 2, net asset value method. Number 3, intrinsic value method. Number 4 is lump sum method. Lump sum. Okay. Or you can also call it as ad hoc consideration method. Ad hoc consideration method. So total 4 popular methods are available. One is net payments method, and the other one is net asset value method, intrinsic value method, lump sum method, or ad hoc consideration method. So first, let me start with lump sum method or ad hoc consideration method. The reason is, in case of lump sum method or ad hoc consideration method, the amount of PC is decided by the purchasing company in ad hoc manner. Ad hoc manner means, sir, amount of PC, how much, sir? 1.5 CR is the PC. How it comes? No, it doesn't tell anything. Not required also. The method itself is just providing the lump sum amount. There is no criteria, nothing. Okay. Just based upon the negotiation power, just they told a simple figure. So just most of the times in the exams, they never provided this. But if they provided to calculate PC under lump sum method, then they itself given the figure. Then their concentration will be on other issues. It's in very minute manner, because a lot of times the examiner want to test the students how they are going to calculate the PC as well. That's why they never ask questions from this particular method. But this type of method also exists. So lump sum or ad hoc consideration method means which is fixed amount of PC. Fixed amount of PC. The ad hoc amount of PC. It itself given in the problem or the question itself. Now, let us discuss the other methods. That is net payments method, net asset value method, intrinsic value method. So let me check with net payments method. In case of net payments method, PC is nothing but we should need to make it sum of the amounts payable by purchasing company to the shareholders of the selling company. That's it. Sir, you already told now that is nothing but PC. The same thing they are telling under net payments method in this manner, that is amount payable to equity shareholders of selling company. How much we should need to check? Amount payable to preference shareholders of selling company, we should need to check. If you add the total amount, which is nothing but PC under net payments method. So the word itself clearly tells to us net payment. Payment to shareholders. So payment to equity shareholders, how much? Payment to preference shareholders, how much? If you make it sum it off, then we will get PC under net payments method. Sir, under net asset value method, how to calculate the PC? Again, the name itself tells net assets. Net assets means assets minus outside liabilities. What are the various assets taken over by the purchasing company? Less what are the various liabilities taken over by the purchasing company? Guys, how you can decide how much amount payable to the other company, that is selling company? I should need to check the worth of the selling company, na? The worth of the selling company is nothing but the net worth, the assets minus liabilities. Sir, here net asset value means assets taken over at your value you should need to consider, or the book value of the selling company you should need to consider. How much value you are going to assign to the assets and liabilities of the selling company is the matter. The book value of the selling company it doesn't relevant here, because sir, in my books, if I am acting as a selling company, I may show at any value, that is depending upon my accounting treatment, right, or my accounting policy. If my business is ultimately taken over by another entity means the other entity, how much value assigned to my assets and liabilities is important, right? So that's why other entity, how much amount is ready to payable to me means how much price assigned by the purchasing company, it matters. So that's why assets taken over at the rate of agreed value is important. Agreed value, at how much value they agreed. Similarly, liabilities taken over at the rate of agreed value is important. Now such assets minus liabilities, if I subtract with each other, then I will get a NAV, which is known as net asset value of business takeover. NAV of business takeover, which is nothing but PC in case of net asset value method, which is equal to PC in case of net asset value method. Is it fine, guys, all of you? So first, let me try to explain each and everything before going with any problems. Sir, my style of teaching is like I cannot tell like this, sir, a concept and a problem. It's not the correct way as well, because a lot of links will be there, like the topics of amalgamation and internal reconstruction. So first, let me put it all the concept entirely in the clear-cut picture. Then you can understand the interlinks as well. Then I will introduce the problem. Then you can understand the flow, where we should need to go, where I should need to pick. Okay, fine. Next, let me come with the intrinsic value method. In fact, there is no difference between net asset value method and intrinsic value method. Both are same in my point of view. Why, sir? Then why they given the different methods? In case of intrinsic value method also, I will consider PC is nothing but NAV only. But in different manner, I am going to calculate the NAV. For example, here NAV, how much you get it, sir? Sir, here PC, I get it, let us assume 100 lakhs. 100 lakhs is my PC. Now, in case of intrinsic value method, how I will explain the same 100 lakhs, how I will provide the same 100 lakhs in this manner. Let us assume in my company, 1 lakh equity shares are there. My company means selling company. For each and every equity share, I'm assigning 100 rupee as their intrinsic value. 1 lakh into 100, again, which is equal to 100 lakhs only. That means in case of net asset value method, 100 lakhs I am deriving assets minus outside liabilities. Here also I am deriving the 100 lakh for the same company, but how I derived, I directly assigned some intrinsic value, which is nothing but intrinsic value is nothing but some market value. In fact, the net asset value per each and every share. The another name for intrinsic value is nothing but the net asset value per each and every share. That itself we can call it as intrinsic value per share or NAV per share. Guys, just give me 1 second. I'm facing some problem with my filter case. 1 second. So pen is not working if I'm trying to write something on screen. Yeah, now it's working. So that is nothing but intrinsic value per share. Sir, do you mean that PC in case of intrinsic value method is nothing but PC is equal to NAV is equal to number of equity shares in selling company multiplied with intrinsic value per share in selling company? Yes, intrinsic value per share in selling company. In another name, you can also give either intrinsic value per share or NAV per share. NAV per share. So the way of expression is quite different from NAV method to intrinsic value method, but the quantum of amount is same. So under net asset value method, PC, we are going to calculate by comparing the assets taken over at the rate of agreed value with liabilities taken over at the rate of agreed value. The difference itself is PC. In case of intrinsic value method, we are going to calculate PC as number of equity shares in selling company multiplied with intrinsic value per share in selling company. Again, how you will get it intrinsic value per share in selling company? Always they will provide that intrinsic value in the problem. If they're not provided, you should need to work out the total NAV. If you divide with the number of shares, then you will get NAV per share in the selling company. That's the reason why I'm telling that PC is equal to NAV. For example, if this is NAV per share in the selling company, NAV per share in the selling company into number of equity shares in selling company is nothing but total NAV of the business takeover, which is nothing but PC. Is it okay, guys? All of you? Any confusion? No, right? Sir, ultimately, after seeing all these methods, what I can tell, in case of lump sum method or ad hoc consideration, the amount itself is given in the problem. In case of net payments method, we should need to check how much amount is payable to equity shareholders of the selling company, how much amount is payable to preference shareholders of the selling company. If you can make it sum it off, then you will get PC under net payments method. In case of net asset value method, you should need to compare assets taken over at the rate of agreed values with liabilities taken over at the rate of agreed value. The difference itself is NAV or the PC. But in case of intrinsic value method, PC is nothing but number of equity shares in the selling company multiplied with the NAV per share or intrinsic value per share in the selling company. Then automatically you will get PC under intrinsic value method. So literally there is no difference between NAV method and intrinsic value method. The way of expressing the figures may be different. My next question is, sir, which method is applicable to my problem? How I know, sir? Right? That is most important thing. Because they may not directly provide, you should need to use that particular method. One second, someone is asking some doubt. Harshit Jaichwal. Sir, in fourth method, equity share also include preference share also or not? No, ma. The point is, sir, equity shares can I include? Preference shares can I include or not? That doesn't matter for me. To whom I am issuing is matter for me. If you are issuing the preference shares to the debenture holders, I will not include. Sorry, if I am issuing the preference shares to the any of the shareholder, either equity or preference shareholder, it is form part. Sir, in any method, don't be confused again. With the methods of PC, don't be confused with the basic provision. This is the basic provision. This basic provision is applicable for all the methods. Whether it is net payments or net assets or intrinsic value method or lump sum method, whatever the case may be, just we are adopting these methods for know the quantum of the PC. Quantum of the PC only. But ultimately, this amount should need to be payable to whom? Should need to be payable to either equity or preference shareholders of the selling company only. It should not be payable to the debenture holders of the selling company. It should not be payable to any of the other liabilities of the selling company. If that is the case, it is not form part of PC. That's it. Do you understand? Fine. So something just I'm discussing in between. I seen this doubt. Okay. So which method is relevant or which method is applicable to my problem? Or how I should need to identify the relevant method of PC for my problem? That is the major issue. Please concentrate, all of you. If the method is ad hoc method or lump sum method, you can simply identify because there is no other information given in the problem, the amount itself directly given. That's why I don't want to discuss anything about this lump sum method or ad hoc consideration. I will only discuss about these three methods, how I should need to check which method is applicable. First, after reading the problem, if you can able to identify, or let me do one thing, okay? Just now I have one thought. Before explaining this, like which method is suitable, Let me provide one example. Then please all of you identify which method is suitable for that particular example. Okay. Later I will tell you how to identify a particular method. I think so that is the better idea. Okay. Let me go in that mode. So 1 second, guys. Just give me a second. It's working, but yeah. Let me give that example. What is that? After this example, I'll tell you how we should need to check. But before that, please all of you try to answer this example. Sir, every equity shareholder in selling company is getting 2 equity shares of purchasing company. Every preference shareholder in selling company is getting 1 preference share of purchasing company. Equity shareholders of selling company is also getting cash, of the purchasing company. I mean, simply we are issuing cash also to the equity shareholders of the selling company. Debenture holders of selling company, they are getting debentures of purchasing company. That is how many debentures, sir? For every debenture of the selling company, let us assume 2 debentures of the purchasing company. Now, my question is, which method of PC I should need to adopt in this case? Please all of you participate and let me know. I'm not asking you the amount of PC. I'm asking you which method of PC is suitable. Please all of you provide your answers quickly. One of my student, like Sunil Kumar, what he is telling, sir, not for this example, he is in generally telling that, sir, net asset method is mostly used because question is given assets taken over value. No, don't conclude like that, my dear. Okay. So out of my experience, I am telling you, lot of times you might have confused if you are in that mode. So don't go in that mode. Please follow or adopt my flow. You can understand later why I'm telling in this deeper manner. So which method is suitable here? Oh, lot of people telling that, sir, net payment method is, sir, net payment, net payment, net payment. Superb. Excellent. All are wrong. All are wrong. The method of PC is not net payments method. The method of PC is net asset value method. Okay. Sunil, that is the reason why I provided this example. Now you can understand here I'm not giving any asset value and liabilities value at which value I'm taken over. Just I'm providing this information. People simply just they trapped and they told that, sir, the method of PC is net payments method. I'll tell you the reason. Okay. Sir, equity shareholders of the selling company will receive cash of the purchasing company. How much, sir? Do you know? Here I told you every equity shareholder in the selling company will get 2 equity shares of purchasing company. I know this value. I can express this value in terms of money. Sir, how many number of equity shares are there in selling company, sir? Let us assume 1 lakh equity shares are there. Okay. 2 equity shares they are issuing into 2. Sir, at which value they are issuing? Multiplied with the issue price. I'll get amount of equity shares received by the selling company. Similarly, I know amount of preference shares received by the preference shareholders of the selling company. Anyway, this is not form part of PC. You can ignore. Amount payable to debenture holders of the selling company is not form part of PC. Just you can ignore. This is not form part of PC. Then here I already told that Equity shareholders of the selling company not only getting the equity shares of purchasing company, they also received the cash of the purchasing company. How much? Anything I provided? No. Then how you can tell the method of PC is net payments method? Because in case of net payments method, what should I require? Equity shareholders of the selling company, total how much they received. Here, equity shareholders of the selling company, they are receiving the equity shares of purchasing company as well as cash also. I know how much amount of or how much worth of equity shares of purchasing company they are going to receive, but I don't know how much worth of cash they are going to get it from the purchasing company. That's why some of the component here was missed out. That's why unable to fix the PC under net payments method. So they will trap you something like this. In the last paragraph, somewhere they provided the assets taken over at the rate of agreed value, something liabilities taken over at the rate of agreed value. Also, they provide something. That means here the method you should need to use is net asset value method. You should need to fix the total amount of the PC. Once you know the PC, to know the form of PC, you should need to use this. Form of PC means, sir, PC, let us assume I got which is 7 crore, sir. Out of this 7 crore, in the form of equity shares, how much, sir? In the form of preference shares, how much, sir? In the form of cash, how much, sir? This equity shares plus cash just given to equity shareholders of selling company. This preference shareholders, sorry, this preference shares of purchasing company just given to preference shareholders of the selling company. You to decide the form of PC, just you can utilize this. To know the quantum of PC, you should need to apply the NAV method. Do you understand, all of you? Sir, then we understand your point, sir. How we should need to face this situation while resolving the problems. That's what I want to explain. How I should need to clearly decide the method of PC. While reading the problem, if I can able to predict or if I can able to assign the value related to amount payable to equity shareholders of the selling company or amount payable to preference shareholders of the selling company, then the method of PC is net payments method. That's it. If I able to calculate amount payable to preference shareholders of the selling company or equity shareholders of the selling company, straight away I will consider the method of PC is net payments method. Sir, from the given information in the problem, I unable to calculate some of the component or some of the information is missing. Then the method of PC is net asset value method. Always there is a confusion in between net payments method and net asset value method choosing only most of the times. Because for intrinsic value method choosing also there is no confusion. You know why? Most of the times they are using the word intrinsic value per share, or at least they can provide like this. Sir, in the selling company, each and every equity share value is this much. Accordingly, purchasing company is payable, or accordingly, the purchasing company is discharging the PCE. Something like that they will provide. So that means if we know the real value or if we know the intrinsic value per share in the purchasing company, sorry, in the selling company, then simply we can decide the PC, which is nothing but number of equity shares in the selling company multiplied with that share price, we will get the PC under intrinsic value method. So that's why to identify the PC under intrinsic value method is also not a big challenge. The big challenge is in between the net payments method and net asset value method only. Is it okay, guys? So ultimately the conclusion is, while reading the problem, if I can able to calculate amount payable to equity shareholders of the selling company, preference shareholders of the selling company, then method of PC is net payments method, otherwise net asset value method. Let me give one more example. Please all of you identify the method of PC. Are you ready, guys? Are you ready? Can I start? The next example is, sir, equity shareholders of selling company will get 25% on net assets of selling company. Equity shareholders of the selling company will get equity shares. will get equity shares of purchasing company. How many equity shares or how much worth of equity shares for that? 25% on net assets of the selling company worth they will get. Preference shareholders of selling company will get 2 preference shares or something like that. Let me give like this. That is 2.5 crore worth of preference shares of purchasing company. So again, I am repeating to avoid the confusion. Equity shareholders of the selling company will get equity shares of the purchasing company and their worth is 25% on net assets of the selling company. Preference shareholders of the selling company will get 2.5 crore worth of the preference shares of the purchasing company. Then can you please let me know the method of PC, all of you? Method of PC. Still I am waiting for answers. Please check. No urgency, so check twice before deciding the PC method. So some are just they are concluding it as net asset value method. Some are still they are telling it as net payments method. I don't know, guys, how many are watching my lectures. So, but please be attentive and please be participative. As I already told you, so I'm always providing a lot of questions and lot of examples, out of book questions. So please be all of you participative. Oh, someone is telling intrinsic value method. Okay. So that means still you can understand the pain right now. Okay. Still, if I gave the conclusions, still you are unable to select the method of PC. If different students, they are telling the different methods means still it is difficult task to conclude the method of PC in any particular scenario. How you should need to check always the thumb rule. I told you one thumb rule. What is that? Sir, while reading the information given in the problem, if you can able to identify amount payable to equity shareholders of the selling company and amount payable to preference shareholders of the selling company, then method of PC is net payments method. Now my question is here, can you able to identify amount payable to equity shareholders of the selling company? Yes, sir, I can able to identify. I may not identify in the direct manner. I should need to do certain computations. I can able to identify, right? First, I should need to work out the net assets of the selling company. Then I will apply 25%. Then I know how much worth of equity shares I should need to issue to the selling company, right? You can make certain calculations. Then you can able to work out how much amount payable to the equity shareholders of the selling company. Tell me, guys. Sir, I am working NAV of the selling company for this purpose. That doesn't mean that the method of PC is NAV method. The method of PC is net payments only, because if I can able to assign how much amount payable to equity shareholders of the selling company, how much amount payable to preference shareholders of the selling company, then the method of PC is NAV only. Sorry, the method of PC is net payments method only. I can able to assign, right? But during that process, to decide or to know amount payable to equity shareholders of the selling company, I should need to calculate NAV of the selling company as well. If I know the NAV of the selling company, on that I will apply 25%, which is nothing but to that extent of or to that worth of equity shares I should need to issue to the equity shareholders of the selling company. During the process of my computation, just I am calculating the NAV of the selling company. That doesn't mean that method of PC is net asset value method. Do you understand? So preference shareholders of the selling company, if you check, directly assign 2.5 CR. So 2.5 CR amount you are giving to the preference shareholder. That doesn't mean that it is lump sum method. Directly provided the information. Then 2.5 CR plus 25% on net assets. If you make it total, then you will know the PC. Yes, sir. That means from the given information, I can able to ascertain amount payable to equity shareholders of the selling company, amount payable to preference shareholders of the selling company. Then method of PC is net payments method only. Sir, then what is your conclusion, sir? Why you are confusing? In too many ways. My conclusion is only one thing. I should need to check only one thing. After reading the information given in the problem, I should need to check whether I can able to ascertain amount payable to equity shareholders of the selling company and amount payable to preference shareholders of the selling company, then straight away method of PC is net payments method. So during that process, I may adopt different methods. To know the amount payable to equity shareholders of the selling company, I may adopt the net asset value method because the problem information is not given directly. Indirectly, they given. During that process, I should need to calculate NAV as well. On that, I should need to ascertain 25%. So to know the value assigned to preference shareholders of the selling company, I'm adopting lump sum method. That doesn't matter, but my method of PC is net payments method only. My conclusion is, what is the base method you should need to check, or what is the overall method you should need to check? Under that, you may apply the sub methods as well. Do you understand? That means the problem may be complicated in such a way that in calculation of PC, you may adopt more than one method. You should need to, if you want to complete this problem, first you should need to check that this is net payments method, and you should also need to know how to calculate net assets, how to identify lump sum amount. Then only you will know total amount payable as a PC by the shareholders of the total amount payable as a PC by purchasing company to the shareholders of the selling company. Is it fine, guys? Yeah, I hope now all are in track. Okay, sir, one more question. I already give all the relevant points here. Okay, fine. You may come across the various questions. No worries. So where the twists are there, directly I'm really revealing now itself. But no worries. Okay, we will check such type of problems or such type of issues while deriving the main track, while deriving the main problems itself. It's more than enough. The other questions, again, we are facing the same issue. At that point of time, I will ask, guys, after reading the problem, can you please let me know which method of PC is applicable here? Then you should need to check all these points and let me know. Still, the PC discussion is not over. So just give some time. Still, I need to discuss some more important issues here. So the next important point in the discussion of PC is how many number of shares issued as PC is also important. Sir, if I know the amount of PC, that is more than enough, right? Why you are talking about number of shares issued as PC? I'll tell you it later. But first, let me know all of you how I should need to calculate number of shares issued as PC. Can you anyone give answer in your query box? Simply total purchase consideration divided by issue price in purchasing company. Do you agree? Sir, for example, under net payments method, if I'm talking under net payments method, let us assume only I am issuing equity shares. There are no preference shares, nothing. Let us assume. Then what I should need to check? Under net payments method, the total PC I will check, divided by issue price in the purchasing company I will check. Then I'll get number of shares issued as PC. For example, if it is NAV method, NAV divided by issue price. If it is intrinsic value method, the total intrinsic value divided by issue price. If it is lump sum method, the total lump sum amount of PC divided by issue price. So simply number of shares issued as PC is nothing but PC divided by issue price in the purchasing company. Then you will get number of shares issued as PC. Do you agree all of you this point? Now concentrate all of you. The recording of PC may be in two manner. The PC may be recorded in both the books. Both the books means in the books of selling company or in the books of purchasing company, whatever the case may be. The PC may be recorded in two ways. One is PC can be recorded at issue price. The PC may be recorded at par value. Par value. Sir, what is the difference between PC is recorded issue price and PC is recorded par value? If the PC is going to record at issue price means the PC is going to record at the real worth. Real worth means number of shares issued as PC, number of shares issued as PC multiplied with issue price. Tell me guys, in this formula, number of shares issued as PC is equal to PC divided by issue price means number of shares issued as PC into issue price in the books of purchasing company is nothing but PC only. The same thing I wrote here. PC is nothing but number of shares issued as PC into issue price. If the PC is going to record at par value means number of shares issued as PC multiplied with face value or par value. We can't understand, sir. Can you please explain one more time? Let me give an example here. What is that? Sir, NAV of a selling company, let us assume, which is 1 crore. And that is simply 100 lakhs. Okay. Now, this is nothing but always the NAV is nothing but related to selling company. Now, purchasing company is going to issue 50,000 equity shares at the rate of 20 rupees each. But the book value is only 10 rupees. Issue price is 20 rupees. 50,000 equity shares are going to issue by the purchasing company to the equity shareholders or to the total shareholder. Only equity shareholders are there. There are no preference shares in selling company. Let us assume. If purchasing company is going to issue 50,000 equity shares at the rate of 20 each to the equity shareholders of the selling company, then automatically PC discharge is over. Let us assume in that manner. Now, if the companies want to record PC as issue price, then purchase consideration is equal to number of shares issued as PC. How many number of shares issued as PC? 50,000. Multiplied with issue price. Issue price how much? 20. So 50,000 into 20. I think so. 1 second. This is not 100 lakhs then. If you work out 50,000 or yeah. So 50,000 into 10, how much? Just let me know. Just give a moment. Just I'm re-verifying the values. 1 second. It's coming 5 lakhs. I'll do one thing. What I'll add, the book value is not 10 rupees. Book value is 100 here. Is 200. Now it is working. Okay. Now concentrate. This is not 20. You can assume it as 200. Sir, number of shares issued as PC into issue price. If I want to record PC at issue price, the number of shares issued as PC is 50,000 into 200. Then PC is how much, guys? 50,000 into 200. Just let me know. It is equal to 100 lakhs, right? That means if the company is going to or the companies want to record PC at issue price, then they are recording PC at their original NAV. But if the same company want to record PC at par value, now the PC is equal to number of shares issued as PC 50,000 into 100, which is equal to 50 lakhs. Sir, but you may ask me that, sir, if the PC is recorded issue price, then only it's correct, na? Then only it is exactly matching with the actual value, na? But if the PC is going to record at par value, then they are going to record the PC at the reduced price. Do you write? Sir, is it allowable? Is it fine? Yes, it is allowable. It is fine. Do you know the reason? Ultimately, let me know how many number of shares received by the selling company. 50,000. Outside market value, how much? 200 shares. Only for book sakes only, I'm recording such PC at a book value, that is 100 rupees. Everyone will know that. Purchasing company will know that. How many number of shares I'm issuing? 50,000. Each share how much? 200. They know. But they are going to record such PC at a book value. Selling company also will know that, sir, outside market value is 200, but for the books purpose, I'm going to record those are at 100 rupees. It's absolutely fine. We can able to record the PC at issue price or PC at par value. And I will not discuss this issue at this moment. I will prove that if the PC is recorded at issue price or PC is recorded par value, there is no difference in accounting treatment as well. Both are same. But you may not appreciate at this moment. Just wait for some more day. I'll try to explain when I'm providing the discussion in the books of the purchasing company. Okay, how it will work out. Whether the PC is recorded issue price, PC is recorded par value, how the both are same. But my point is, if at all in the problem it is clearly given that PC is recorded at par value, then first of all you should need to calculate number of shares issued as PC. Once you know the number of shares issued as PC, you should need to multiply with the par value. Then you will know the total amount of the PC. Sir, if nothing is given, generally you should need to calculate PC at a issue price only. No need to check. Sir, PC is recorded issue price or par value. No need to check. If nothing is given means always PC is recorded at issue price only. In the normal methods only you will calculate the PC. That is the methods what we discussed. If net payments method, how much PC is there? Which already the PC is at issue price only. But to record such PC at par value only, first I should need to calculate number of shares issued as PC. Then I should need to multiply with the face value. Is it fine, all of you? Let me know quickly. Please, all of you. Sir, difference between issue price and par value is premium, sir? Yes. In case of purchasing company, the excess 10 rupees, we can call it as premium because the share is issuing, the 10 rupees is premium only, which is the difference between issue price and the book value. Correct. You are right, ma, which is premium only. Okay. Is it fine, right? Can I continue, guys? Yeah, fine. Now, please concentrate. This is the last point. Just I want to discuss about the PC. So after this, nowhere I'm talking about the PC. Only I'll discuss the relevant points in the problems. Please concentrate. So the point is, method of PC is intrinsic value method, and PC is going to record it par value. This is the case. Then how to calculate PC is the matter of discussion. I already discussed everything. If PC is under intrinsic value method, how to calculate PC? I know already. PC is equal to number of equity shares in selling company multiplied with the intrinsic value per share or intrinsic value per share in selling company. I know this already. But PC is recorded at par value means how we are going to calculate the PC? Number of shares issued as PC into face value or par value per share, right? Tell me, guys. So if you want to record the PC at par value, the formula is number of shares issued as PC. First of all, what I want to know, how many number of shares issued as PC by the purchasing company? First, I should need to check. How many number of shares issued by the purchasing company? How I will know? Simply the total amount of PC, if I divide with the issue price, I know the number of shares issued as PC. That means PC divided by issue price means here the PC divided by issue price. Sir, instead of issue price, what I'll write? Intrinsic value per share in purchasing company. You know why? At which value purchasing company is going to issue, sir? At their market value. at their original price. At their original price means intrinsic value per share in the purchasing company. If nothing is discussed means the issue price in the books of purchasing company is nothing but intrinsic value per share in the purchasing company only. This intrinsic value per share in the purchasing company is nothing but issue price in purchasing company. This is nothing but number of shares issued as PC. Tell me guys, this is nothing but number of shares issued as PC. Do you agree? Simply what I did here, just a moment guys. Okay, let it be, leave it. It's not working. So what I did here, intrinsic value per share in the purchasing company, if I use, which is nothing but issue price per share in the purchasing company only. Simply I did PC divided by issue price is nothing but number of shares issued as PC only. I'm talking the same thing. Number of shares issued as PC is nothing but number of equity shares in selling company multiplied with intrinsic value per share in selling company, which is PC, divided by intrinsic value per share in purchasing company. Then I will get number of shares issued as PC. Then if I know number of shares issued as PC, if I want to record the PC at par value, I should need to multiply with the face value or par value. Do the same thing into face value or par value in purchasing company. Then you will get PC under intrinsic value method, which is recorded at par value. Sir, if you want to record the same thing at issue price, here you should need to multiply with the issue price, right? Sir, issue price is nothing but intrinsic value per share in purchasing company only, right? Intrinsic value per share in purchasing company, this one, this one. If cancel with each other, then PC is nothing but number of equity shares in selling company into intrinsic value per share in selling company. Tell me guys. Sir, what you want to try to tell here, sir? Simply, if in the problem, if they clearly given that PC is recorded par value, don't calculate PC directly. First try to work it on number of shares issued as PC. Then you should directly multiply the par value per share in the purchasing company. No. In the problem, they not mentioned to record PC at par value. Then directly simply calculate PC by applying the above method. That's it. So if the question is calculation of PC is under intrinsic value method and recording of the PC at par value, then the little bit complication is there. So at that moment, first you should need to work out number of shares issued as PC. Number of shares issued as PC is nothing but the intrinsic value of the selling company, which is nothing but PC, divided by issue price, simply. Then you will get number of shares issued as PC. Sir, the PC is nothing but number of equity shares in selling company into intrinsic value per share in selling company, which is nothing but intrinsic value of the selling company. I know that, divided by issue price in the purchasing company means intrinsic value per share in the purchasing company. Then if you check this factor, you will get number of shares issued as PC. If you want to record this PC at par value, then multiply with the par value. Then automatically the PC under intrinsic value method recorded at par value, you will know. That is what I want to discuss. Is it fine, guys? In both the methods, number of shares same. Yes, absolutely. In both the methods, whether PC is recorded par value, PC is recorded issue price, number of shares will be same. Only the multiplication factor. If it is at par value, we should need to multiply with face value. If it is at issue price, we will multiply with issue price. Yes, Sunil, you are right. Fine. Okay, super. Right, with this, I almost done with the purchase consideration computation, guys. Okay. So don't worry, sir, how we should need to recollect each and everything, because a lot of content you are delivering, lot of issues you are delivering. Okay. Just don't mind. At the end of my session, I'll give like mind map. So in the mind map, you can simply recollect all the things. The same mind map you can utilize for your exams as well. No worries. So this is all about method of PC, and let me discuss something related to accounting treatment in the books of selling company. Or else you can do one thing. Or do you want to do any problem on calculation of PC? Just wait for tomorrow session. Why? Because definitely at the time of discussing either accounting treatment in the books of selling company or accounting treatment in the books of purchasing company, without having the purchase consideration, I can't move. So then why can't I spare separate time for calculation of PC problems? So along with these concepts, let me add up the purchase consideration computation as well. So please be wait till the time. Okay, fine. So then let me discuss accounting treatment in the books of selling company, guys. So accounting treatment in the books of selling company. First of all of you, let me know in the books of selling company, is it AS14 applicable or not? I already told you. Let me know, is it AS14 applicable for the purpose of providing accounting treatment in the books of selling company? I clearly mentioned AS14 doesn't applicable. AS14 only applicable for calculation of PC as well as accounting treatment in the books of purchasing company. Fine. Hope you clear on this. Sir, if AS14 is not applicable, then who decides the accounting treatment in the books of selling company? Gap, generally accepted accounting principles. Simply, what is that gap? Sir, in the books of selling company, what is going to happen? Just they are going to liquidate, they are going to close their books of accounts, right? The accounting procedure in generally adopted at the time of closure of the business, you can simply adopt. That means gap related to closure of business, gap related to closure of books of accounts, I should need to adopt. That's it, which is a general accounting treatment. General accounting treatment means at the time of close of any business, not only the company, either sole proprietor, either partnership firm, either trust, any organization, which accounting treatment you are going to adopt, the similar accounting treatment you should need to adopt. No need to check any provisions, no need to check which method of amalgamation is here is applicable. Is it amalgamation in the nature of merger? Is it amalgamation in the nature of purchase? Sir, can I need to check which method of PC is also applicable? If net payments method is applicable, then one type of accounting treatment. If net asset value method is applicable, another type of accounting treatment. No, no need to check all such factors. Simply in the books of selling company, the generally accepted accounting principles are the normal accounting provisions which I should need to adopt at the time of closure of any typical entity. The same treatment I should need to continue here. Do you understand all of you this point? So that's why accounting treatment in the books of selling company doesn't impact on the basis of type of amalgamation, on the basis of method of PC. These two are completely irrelevant to provide the accounting treatment in the books of selling company. Any method of PC is applicable. Any method of or any type of amalgamation is applicable. But accounting treatment in the books of selling company is constant. That is nothing but simple provisions related to closure of business I should need to adopt. Okay. So now let me discuss this point. If a business organization or if a company want to close their books of accounts because their company is ultimately selling to the purchasing company, right? Then what it should need to do? Let me explain this entire information through a small example, guys. I know the time is bit like we have approximately 10 minutes. Definitely, I can't tell the entire thing, but at least let me introduce that example in this lecture itself. I'll continue the same example for further session as well. Fine. So let us go to the other PDF. One second. Yes. So no worries, guys. Everything I noted down already in the PDF. What I'm going to explain in my OneNote. And for your convenience, whatever the things I am writing under OneNote also I'll share at the end of sessions. Okay. Fine. Now, please, all of you come to this particular example. So this example we are dealing for the purpose of knowing the accounting treatment in the books of selling company or in the books of transferor. The problem is balance sheet of the selling company as at 31st March 2021. Just they are providing. Under asset side, PPE is there. Under property, plant and equipment, two major assets we have. One is plant and machinery and the other one is land. One is depreciable asset and the other one is non-depreciable asset. Intangible assets are also there. So in bracket represented as goodwill. Miscellaneous expenditure not written off, which is a fictitious asset, is there. Fictitious asset means which is not an asset. Like maybe this is nothing but okay, huge expenditure incurred on any for particular purpose. They may not be write off in that particular year, but it may not be allowable as per existing Companies Act 2013. So as per old provisions, it will be allowable. So right now there is no place for miscellaneous expenditure not written off. But anyway, just I'm following the legacy. So current assets, inventory given, cash given, trade receivables is there. If you're coming to equity and liabilities, under equity part, equity share capital is there, preference share capital is there, reserves and surplus, security premium, general reserve, P&L is there. Non-current liabilities, 10% debentures is there. Current liabilities, trade payable is there. Sir, you may ask one question. Sir, we are learning the external reconstruction if the company is incurring losses only. But I told you the objective of amalgamation is different. We are talking about amalgamation. We are not talking about pure external reconstruction. So that's the reason why losses are not exist. So this is a profit-making company. Absolutely, this is a fine profit-making company. It doesn't have any relevance with external reconstruction, to be frankly speaking, because which is not a loss-making company. My objective is here not to provide the financial statements at true and fair view. My objective is this company is ultimately taken over by another entity. Just I want to make it amalgamate with each other, or simply it is the process of absorption. You can call it as absorption, maybe. The new company is an existing company, you may call it as absorption. Sorry, the new company is an existing company, then you may call it as absorption. Am I right? Fine. Now my ultimate objective is I want to close the books of this particular company. Some more additional information is also given. The new company or the existing company, simply I can call it as purchasing company. The purchasing company want to take over all the assets except cash. Here it is clearly given, except cash. Purchasing company want to take over all assets and liabilities of the selling company. PC is given at 70 lakhs. PC is under which method? PC is given at 70 lakhs. PC is under which method? Lump sum method. In the example, why I provided PC directly, here my intention is how to calculate the PC. Here my intention is like providing accounting treatment in the books of selling company. Not my intention is to know the amount of PC. So that's why I directly given the PC amount. PC is under lump sum method 70 lakhs. But don't expect like this in the exams. Okay. Liquidation expenses 2 lakhs because the selling company is going to liquidate. That's why definitely it will incur some liquidation expenses. Preference shareholders of the selling company will get preference shares of the purchasing company. Okay. Because here if you check, equity shareholders of selling company exist, preference shareholders of selling company exist. So preference shareholder of the selling company will get preference shares of the purchasing company. So then equity shareholders of the selling company will get whatever the remaining balance issued by the purchasing company, it will ultimately goes to the equity shareholders only, right? That's why not mentioned clearly. Now, what I should need to provide? closure of books of accounts or simply accounting treatment in the books of selling company I'm going to discuss. Now, can you please tell me, guys, all of you, now accounting treatment in the books of selling company means what we should need to do? I should need to close all the books of accounts. Sir, closure of books of accounts means you should need to pen down and put down the paper something like this, then automatically closure happen? No. You should need to make it 0 for each and every specific account. If the account shows the nil balance, then automatically books of accounts will be closed. Then how I should need to do? Please all of you concentrate here. Let me take up this example in my OneNote as well. 1 second. So now I'm talking about accounting treatment in the books of selling company. So which is closure provisions, right? Sir, I have under asset side, I have PPE. So I have cash balance, something like that. I have miscellaneous expenditure not written off. I'm having some other current assets as well. Just to give a moment. 1 second. My God. So the USB cable is missing, unable to do alt tab. Just I want to change the slides. Just be online, guys. 1 second, please. Yeah, fine. Concentrate. Right. Sir, under PPE, I have plant and machinery, land. Under intangible assets, I have goodwill. Under current assets, I have some other assets like inventory, cash and trade receivables, and miscellaneous expenditure not written off as well. Now, let me know all these balance sheet items, whether it is asset or liability, they are having their balances in their individual ledgers. For example, if I consider like plant and machinery, they are having their individual ledger, something like this, right? So plant and machinery, it have 20 lakhs. So don't see the other components, or I am unable to go back to my OneNote, and simultaneously I am unable to show both the things at a time. So let me check those under the next session. So please all of you just imagine in your mind, plant and machinery account is there. Opening balance, it will be something like this, two balance brought down. So similarly, let me take one liability. Let us assume 10% debentures is there. So if I open in the ledger, it will be their buy balance brought down 20 lakh. So that means if the balance sheet of the selling company is exist in the problem means all their individual assets and all their individual liabilities are there in their individual ledgers. Do you agree all of you this point first of all? Now, all these assets and all these liabilities, I'm sell over to the purchasing company. I'm sell over to the purchasing company means definitely I should need to receive something from the purchasing company. I should need to sell it off, these assets and liabilities. Do you agree this point? Sir, at the time of sale of any particular good itself, you are pretty much eagerly waiting for knowing profits or losses. Like this, right now you are going to sell off your entire business to the another entity. Definitely you should need to know the profit or loss derived due to your sale of the business. Sir, you are unable to sell the individual assets and liabilities to the purchasing company. You are going to sell the group of assets and liabilities to the purchasing company. That's why what I want to do first, all such group of assets, I want to make it transfer to one specific account. For example, if I transferred all these group of assets and all these group of liabilities, liabilities means these are only the real liabilities. If I make it transfer to one specific account, then I can compare the net book value of these assets and liabilities with the purchase consideration what I am getting. Then I know the profit or loss. Simply, for example, this is some specific account. Under this specific account, one side NAV is there. NAV means as per my book value. This is not the real NAV. This is as per my book value, or simply not NAV. Net book value is there. Let us assume net book value is there. In another side, PC is there. Let us assume. Then the difference between PC and net book value is profit or loss due to sale of my business. That profit or loss is ultimately belong to shareholders of the company. Tell me, guys. Now, if I distribute the PC as well as profit to the shareholders of the selling company, then the shareholders accounts also got closed. Then entire my books of accounts got closed. Do you agree? So just an idea only I'm giving. Don't be confused. So that's why my intention is what I want to do. The individual accounts of assets and liabilities, just I want to make it transfer to another account. In that particular account, I will compare the net book value of assets with the purchase consideration. Whatever the profit or loss derived due to the sale of business, I will ultimately transfer to the shareholders. Then PC also I will distribute to the shareholders. Then I will close the business automatically. Then there will be no balance in any particular account. How that magic happen, how such things we are going to check, we'll tell you in the next session, guys. Hope you enjoy my session for today. So I'm not at all explaining anything related to accounting treatment in the books of selling company. The basic idea just I gave. So in detailed explanation, we will check in tomorrow's session. Until bye, guys. Have a nice day.